Stop. Do not confuse what you are watching with a war trade. I know what you are thinking right now. You are looking at gold surging to $5,330 per ounce on Monday morning, March 2nd, 2026, and you are telling yourself this is a crisis spike. You are telling yourself the smart move is to wait for the ceasefire and buy the dip. They want you to believe that. They want you to believe the whales only moved because bombs fell on Tehran. They are wrong. In fact, they could not be more wrong. The whales moved before the bombs fell. The institutional repositioning happened in the days and weeks before the first strike. The war did not create the trade. The war simply confirmed it. It is Monday, March 2nd, 2026. Gold is trading at $5,330 per ounce. Ladies and gentlemen, Vault Tracker here. You need to understand what the whale moves are actually telling you. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. Let us talk about the architecture of what you are looking at right now. Because gold's technical structure did not form overnight, and it did not form because of a weekend of military operations in the Middle East. This pattern has been building across months, and if you understand its anatomy, the Monday morning open makes complete sense. The inverse head and shoulders that dominated discussion in earlier sessions has now evolved into something more powerful. The left shoulder was formed during the February correction. The drawdown from the all-time high of $5,594.82 recorded on January 29, 2026, all the way down to the corrective low of $4,403 during the war shock. That left shoulder represented institutional accumulation at depressed levels. Smart capital loading up while weak hands panicked. The head was formed during the brief test of the $5,000 bedrock zone, the level where sovereign accumulation programs and structural demand created a demand floor so deep that it held on every retest. The head tested that floor, confirmed it held, and bounced. The right shoulder formed during the February 20th to February 27th consolidation range between $5,100 and $5,250. That compression zone, the eye of the storm, was where institutional positioning quietly rebuilt, where those who understood what was coming were methodically adding exposure. The neckline of this entire structure sits at the $5,200 to $5,250 zone. Analysts note that gold is now trading at $5,330 per ounce as of Monday, having cleanly broken through that neckline on the February 28th close and confirmed the breakout on the Monday open. The measured move from this inverse head and shoulders carries a mathematical destination. The distance from the head at $4,403 to the neckline at $5,250 equals approximately $847. Project that distance upward from the neckline breakout point, and the technical destination of this pattern arrives at $6,097 per ounce, not far from where JPMorgan has planted its year-end flag. Here is what the tourists miss. This pattern was valid before the war started. The breakout above 5,200 was structurally happening regardless of events in Tehran. The geopolitical escalation accelerated the timeline. It compressed months of price discovery into days. But the direction of travel was already written in the anatomy of the technical structure. The Monday morning gap, from Friday's close to Monday's open, near $5,368, represents the highest opening level since January 30th, 2026, according to market intelligence as of Monday. U.S. gold futures surged 2.58% to $5,382.60. During the session, gold tested the 5,400 level, which represents the Goldman Sachs intermediate price target established before the war began. Now pay attention to this detail. The 5,400 level is not just a Goldman target. According to analyst frameworks, the zone between $5,400 and $5,608 represents the upper resistance band where the full technical advance could arrive, assuming no breakdown below the neckline zone. Above 5,600, gold re-enters uncharted territory above its all-time closing high, with the measured move target from the larger pattern structure pointing towards $6,000 to $6,300. The coiled spring is no longer coiling, the spring has fired. The question now is not whether the breakout happened. The question is whether the weak hands will try to manufacture a reason to doubt it. Do not let them. Let us go into the whale room. Let us talk about what the institutions actually know that most retail participants have not processed yet. On February 25, 2026, JPMorgan executed a move that barely made headlines in mainstream financial media. The bank raised its long-run steady-state gold forecast by 15% to $4,500 per ounce, according to reports from Reuters. Simultaneously, it locked in its year-end 2026 target at $6,300. Let me put this in perspective for you. Raising the long-term steady-state forecast is not a tactical call. It is not a war trade. It is JPMorgan telling its largest institutional clients, the ones managing pension funds, sovereign wealth funds, endowments worth hundreds of billions, that gold's permanent baseline valuation has moved permanently higher. The floor has been lifted. The world has changed. In the bank's own language cited across intelligence reports, this reflects increased weighting for a reserve currency paradigm shift, public announcements of U.S. Treasury divestment, and nations actively shifting revenue bases away from the dollar. And then there is the bull case. JPMorgan has also laid out the scenario where gold reaches $8,000 to $8,500. That scenario requires only one thing: Western households raising their gold portfolio allocation from less than 1% of total assets to approximately 4.6%, according to institutional analysis sources, not 4.6% of the total economy, 4.6% of household portfolios. That is how underinvested the retail layer of this market still is. That is how much dry powder exists on the sidelines. The whales have already moved, the households are barely starting. Now layer on the institutional flow mechanics. According to World Gold Council January 2026 Flow Intelligence, global gold exchange traded fund trading volumes exploded to $320 billion per day during January, up 73% month over month. North American funds alone recorded $7 billion in January inflows, extending their streak to 8 consecutive months of positive flows. Trading in gold ETF products reached $23 billion per day during the same period, a 160% monthly acceleration. These are not small retail positions. These are institutional mandates being executed at scale. And the crown jewel of the whale flow story, the world's largest physically backed gold exchange-traded fund crossed the $180 billion threshold in total assets under management during February 2026, according to market data compiled as of March 2, 2026. $180 billion in a single fund. Think about what that means for the physical gold market. Every dollar of that represents an obligation to hold physical gold in allocated vault storage. There is no paper substitute. There is no fractional reserve workaround. That is real metal, vaulted, owned, and held by the largest institutional allocators on the planet. The central bank seesaw beneath all of this continues to compress supply from the sovereign level. According to JPMorgan's published forecast model, central bank and institutional investor demand will average 585 tons per quarter through 2026. That is 2,340 tons of annual absorption, representing approximately 70% of total annual global mine output of roughly 3,300 tons. Combine that with the 800 tons per year in official sector purchases that multiple institutions project for 2026, and the net demand pressure on the physical market is structural, persistent, and indifferent to whether any ceasefire gets announced this week. The war added a 5 to 10% risk premium layer on top of a structure that was already driving gold higher before the first strike. That is the hidden mechanism. That is the seesaw that the tourists cannot see. Now let us talk about who is in the room and who is not. Because the gap between tourist thinking and diamond hand positioning has never been wider than it is on Monday, March 2, 2026. The tourist is watching gold at $5,330 and calculating the war premium. The tourist is running mental arithmetic. If the ceasefire comes tomorrow, how much does gold give back? That is the tourist's framework. They are trying to strip out the geopolitical layer and find the baseline. And they have a point worth acknowledging because there is a war premium embedded in current prices. Goldman Sachs Commodity Intelligence, according to reports, has calculated an $18 per barrel war risk premium equivalent in crude oil mechanics that translates into gold's monetary layer. When oil carries an $18 war premium and gold moves in historically correlated fashion, a portion of Monday's gold move is indeed conflict-specific. But the diamond hand is doing a completely different calculation. The diamond hand is asking what was gold doing on February 25th, before the bombs fell. The answer is that gold was already trading above $5,200. The diamond hand is asking, why did JPMorgan raise its permanent baseline forecast to $4,500 on February 25th, 3 days before the operation began? The diamond hand already knows the answer. The structural repricing of gold had nothing to do with a single weekend of military operations. It had everything to do with the deepest, most patient, most methodical accumulation campaign in the history of the global monetary system. Here is the sentiment divergence made visible in data. During the February correction, when gold fell from $5,594 to $4,400, global gold exchange traded fund inflows did not stop. They slowed, but even on the most severe single-day correction in 12 years, North American funds recorded positive inflows of $334 million, according to World Gold Council intelligence. Even when the price was screaming that the rally was over, the institutional mandate kept buying. That is what diamond hands at the institutional scale look like. Now observe what happened on the other side of the sentiment ledger. When the Iran operations began on February 28th, on-chain data and exchange trackers show that the largest crypto derivatives platform saw its open interest fall approximately 25% as traders turned defensive. Over $515 million in crypto liquidations wiped out approximately $128 billion in total cryptocurrency market capitalization during the weekend, according to community trackers and on-chain data sources. Bitcoin, the asset that its advocates have been calling digital gold, fell below $64,000 in the immediate aftermath of the strikes. It briefly bounced on the news of Khamenei's death before settling back around $65,000. Net result, Bitcoin essentially went nowhere while gold advanced to $5,400. Analysts note that Moody's chief economist publicly stated that gold and silver may be more vulnerable than investors currently assume, arguing that much of the current demand is momentum-driven, and that if broader market sentiment reverses, the safe haven narrative could unravel. That is the bear case. It is not irrational. If this conflict de-escalates in under 72 hours, some war premium will compress. Acknowledge the risk. Understand it. Then make your decision with full information. But here is what the bear case model cannot account for. JPMorgan raised its long-term baseline forecast 3 days before the war started. The whale moves were not war moves. They were structural repositioning moves. The war simply validated what the institutions already knew was coming. Let us conduct the autopsy on the digital gold narrative in real time. Because the death certificate was written this past weekend, and it deserves to be read clearly. For the past 3 years, a significant faction of the financial media has promoted a specific argument that Bitcoin represents a generational improvement over gold as a store of value. The argument rested on programmable scarcity, censorship resistance, borderless transfer, and a 21 million coin ceiling. Sophisticated proponents pointed to institutional adoption via spot exchange-traded funds, growing sovereign interest, and BlackRock's entry into the space as evidence that the digital gold thesis had matured beyond ideology into institutional acceptance. That thesis faced its most serious stress test on the weekend of February 28th to March 2nd, 2026, and the verdict is now in. According to analyst reports, Bitcoin fell below $63,000 in the immediate aftermath of the Iran strikes, dropping in close alignment with what equity futures were doing, trading like a high-beta technology stock rather than a monetary safe haven. Sources confirm that Bitcoin had shed more than a quarter of its value in the 2 months leading into the crisis. Year-to-date 2026, gold is up over 22%, while Bitcoin has moved in the opposite direction. Here is the brutal comparative arithmetic. Gold added roughly $1 trillion to its global market capitalization in a single 6-hour window on Monday morning, according to live market data tracked as of March 2nd. Bitcoin's market capitalization declined by approximately $80 billion during the same geopolitical event. One asset absorbed fear and converted it into monetary demand. The other asset experienced fear as a liquidation event. The tortoise did what tortoises do. It advanced steadily on the weight of 7,000 years of human history. The hare recalculated its algorithm. Now consider the institutional framework comparison more deeply. JPMorgan has a $6,300 year-end target for gold, based on a model that explains approximately 70% of quarterly price changes through measurable demand flows, 585 tons per quarter from central banks and investors combined, according to published institutional research. That is a quantitative, verifiable, back-tested relationship between physical demand and price. Bitcoin has no equivalent demand model. Its valuation is entirely sentiment-dependent. When sentiment flips, as it did on the weekend of February 28th, there is no central bank with an 800-ton annual purchase mandate standing under Bitcoin at $60,000. Here is the contrarian angle. The mainstream media will not say out loud. Bitcoin could still be a compelling long-term technology bet. The network may have genuine utility for specific applications. The asset may recover and rally, but it is not gold. It has never been gold. It does not behave like gold when real fear enters the room. And the data from this weekend, from its behavior in the precise moment when the digital gold narrative was supposed to be validated, confirms exactly that. Analysts note that Wells Fargo Investment Institute placed its 2026 gold target at $6,100 to $6,300. UBS raised its targets to $6,200 for March, June, and September 2026. Societe Generale projects $6,000 by year-end 2026. Deutsche Bank sees the same level. Morgan Stanley's bull case points to $5,700 for the second half of 2026. These are not crypto Twitter accounts posting memes. These are the largest financial institutions in the world, all pointing in the same direction, all pointing at gold. The whales have spoken. The question is only whether you are listening. Let us build the battle plan. Because understanding the whale thesis is one thing. Executing your own position with discipline is another. Here is the War Room breakdown for March 2nd, 2026, and the weeks ahead. First, understand the critical distinction that will define everything that follows: the difference between the war premium layer and the structural floor. The war premium represents the additional price appreciation gold captured specifically because of the Hormuz disruption, the Khamenei death, the retaliatory strikes across Gulf capitals, and the breakdown of global shipping routes. According to Goldman Sachs' commodity desk analysis cited by intelligence sources, the embedded war risk premium in current gold prices corresponds to a sustained oil disruption scenario involving partial closure of the strait. If diplomatic contact resolves the conflict within 72 hours, some of that premium will compress. That is the risk you must price into your tactical framework. The structural floor cannot be moved by a phone call. The structural floor is built from 15 consecutive months of central bank gold accumulation, pushing official holdings above 2,300 tons, the highest level in modern history. The structural floor is built from 8 consecutive months of North American institutional inflows, 800 tons projected in global central bank purchases for full year 2026, and $180 billion of physically allocated metal inside the world's largest gold exchange-traded fund. No ceasefire announcement moves those positions. They are locked, they are long-term, they are structural. Here is the 5-level battle map. Level 1. The sovereign bedrock at $5,000. This is the line in the sand below, which 15 months of institutional accumulation has established a demand structure so deep that retail selling alone cannot penetrate it. JPMorgan's $4,500 long-term steady-state forecast provides the analytical anchor. Even in the most pessimistic scenario, the structural demand from sovereign accumulation does not begin to reverse until significantly above current price levels. Level 2. The February consolidation support at $5,100 to $5,200. This zone represented the right shoulder compression on the inverse head and shoulders pattern. A pullback into this zone on any ceasefire announcement is not a breakdown signal. It is a gift. This is where the back up the truck decision lives for anyone who missed the initial advance. Level 3. The Monday confirmation zone at $5,300 to $5,330. The March 2nd open confirmed at $5,368 to $5,390. Live price as of early March 2nd trading session sits at $5,330 per ounce, according to live market intelligence. Sustained closes above $5,300 confirm the breakout is structural rather than war premium only. Level 4. The Goldman Sachs intermediate target at $5,400. Already tested Monday morning. A clean close above $5,400 removes the Goldman target as resistance and opens the technical path toward the upper band. Beyond $5,400, analysts flag $5,500 as the next significant level, with the January all-time high at $5,594 as the record to breach. Level 5. The year-end consensus destination at $6,000 to $6,300. JPMorgan's year-end target, Wells Fargo's upper range, UBS's multi-quarter projection, Société Générale's year-end call, Deutsche Bank's forecast. These institutions are not agreeing by accident. 2 scenarios to prepare for. Scenario 1. Escalation persists through the week. The conflict's reorganized command structure means it cannot be resolved by a single decisive strike. If Hormuz disruption extends beyond 5 trading days, the oil inflation transmission into gold's monetary layer accelerates. Gold closes the week above 5,400. Trajectory toward 5,600 opens. Diamond hands stay fully positioned. Scenario 2. Rapid diplomatic contact. If diplomatic communication produces a credible de-escalation signal, gold's war premium layer compresses toward 5,100 to 5,200. But, and this is the critical insight, the structural floor absorbs the retreat. The back up the truck moment arrives for anyone who waited. The path toward 6,300 remains intact. The whales do not exit, they reload. Here is the question I want you to answer in the comments. Do you believe JPMorgan raised its long-term gold baseline to $4,500 because of this weekend's events, or because the reserve currency paradigm shift was already underway before the first bomb fell? Stay positioned. Stay patient. The whales moved first. Vault Tracker here. See you at the next level. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.